Hey, my name is Brandon Osborne. Some people call me OZ, some people call me OZ Effects. But today we're going to be talking about the fair value gap. And I know it feels like we talk about fair value gaps a lot, and that's because we do. And it's because I use them a lot. They're one of the most important factors in my own trading. Since I use them so much, I figured it would be a good idea to make a clear cut video where you can take notes. And anytime you have a question, anytime you feel confused about a fair value gap, you have a place to come to. You have a reference or a resource. Watch or take notes. If you take notes, you don't have to keep coming back to the video, and you can clear up any questions you may have with a fair value gap. This video is going to be relatively simple, clear cut, and to the point. I'm going to have some notes up here on the screen, and then I'm going to have some chart examples at the end. And that's really all you need. We do not need to overcomplicate this at all. It is very simple. It's just overlooked. It was overlooked. It's becoming quite big right now. Order blocks used to be the thing, and now it's the fair value gap. And fair value gap is my favorite method of trading right now. So let's get into it. What is a fair value gap? Fair value gaps are most commonly used amongst price action traders and are defined as instances in which there are inefficiencies, imbalances in the market. These imbalances simply suggest that buying and selling are not equal. Simple enough. It's just an area where there was only buying or only selling. There, there was no battle back and forth between buyers and sellers. It was a clear win between bullish or bearish. All right. What makes a fair value gap? Fair value gaps are created within a three candle sequence and are commonly visualized on the chart as a large candle whose neighboring candles' upper and lower wicks do not fully overlap the large candle. In most cases, there is almost always going to be a very large candle, and that creates the fair value gap. You need a large impulsive displacement candle to create a fair value gap. Not always, but those are the best ones. Those are the easiest ones to find, and those are the ones that the market and the algorithm tends to want to fill in first. All right, here we got an example, and this is just so that I can basically point out everything that I just went over. All right, so the distance between this low right here, this wick, and this high of this candle right here, this wick. You got candle one, you got candle two, which is the big, energetic, impulsive candle that creates the fair value gap. And then you got candle three. Remember, it's a three candle sequence, at least three candles. The imbalance or fair value gap can continue for multiple candles, but most cases they don't, because there's always this little wick that pops up. Not always. If this wick wasn't here or this wick wasn't here, you could continue the entire fair value gap, but most cases you don't. Normally, it's just going to be a three candlestick combination, and most times it's going to be very easy to see because you're going to have these big energetic pushes. If you look to the next three candles, one, two, three, there's literally another fair value gap right here. And I'll draw that out for you. That way you can see it. The low of candle number one and the high of candle number three. This entire area in here is your fair value gap. Pretty simple, right? Fair value gap to the left, to the downside equals a bearish fair value gap. You would look for an entry. All right, so moving on. There are three ways to enter using a fair value gap. One, the top, two, the midpoint, and three, the bottom. If I go back to this, you got one, the bottom, two, the midpoint, and three, the top. You want to pick one of these, either the top, the bottom, or the midpoint, to enter on your fair value gaps every single time. You don't want to switch it based on the chart example. You want to pick the same way every single time. That way your results can stay consistent with what you were doing. How do we use a fair value gap? This is what everybody wants to know. I can give you all the information on what they are, but unless you know how to utilize it to make money or make hypothetical money, this is it right here. This is the simplest way to use a fair value gap. And this is really all you need. So, whoops. First, you locate the fair value gap by looking for an impulse, breaking structure in your desired direction. And then two, you draw the fair value gap. Three, you place the limit order on either A, the top, B, the midpoint, or C, the bottom of the fair value gap. And we are going to go over to the charts now, and we are going to use this list right here, the steps, and see what we can find or see how you would use this list. Find a good example. Bear with me for 1 minute. Let me go to the 1 hour time frame. All right. So literally we have an example. We have a couple examples. I'll use this one over here because this looks like a very good clean cut. So if you were going to use that list of steps that I just gave you, how would you use it? Well, what's step one? You locate a fair value gap by looking for an impulse, breaking structure in your desired direction. So first, you kind of do need to know the desired direction. I guess that could have been first, but this is just strictly on how you use a fair value gap. So if you know that you're looking for buys, you're going to want to be looking for breaks of structure and impulses to the upside that leave behind a fair value gap. And what do we got here? So we got first break, that's a break of structure. Got the second break of structure, and you got the third break. Multiple breaks, regardless, you can see this is a big impulsive move to the upside, which is your desired direction. And then step two was what? Draw the fair value gap. So you typically want to use the first fair value gap or the biggest fair value gap. Okay. This needs to be drawn a little bit better. There's another fair value gap below. And as long as your stop loss is below the low of the impulse, always use the top one. You could use the bottom one down here. And yes, this one did work, but it could have very easily just came to this one and moved without you. So at this point, let's get rid of this one because you really only need to worry about this one because wherever the impulse started from is where your stop loss is going to go every single time. So say this was what you could see on the chart right now. You have identified a fair value gap by looking for a break of structure and an impulse in your desired direction, which in this case is to the upside. Okay. You draw your fair value gap, step two. And then step three is literally place your limit order where you decide you want to place it inside of the fair value gap. I use the midpoint. So at this point, I would put a limit order right here, stop loss below the low. Okay, let me draw that out for you so that way you can see exactly where I'm talking about. That's the stop loss right there. Below the low point of the impulse, okay? And then take profit would be, that's up to you. You kind of probably would go out to a higher time frame and find a higher time frame level, okay? Then it would come in and react and do whatever it does. I'm pretty sure that would have been a winner. If you would have taken profits up here, it would have been, which this is a whole completely hypothetical. It still wouldn't be a loss, but I think it's going to keep going. But that's exactly how you would use that. Break structure, fair value gap, return, enter. That is it. Doesn't have to get any harder than that. If you have any questions, leave them down in the bottom. I'm going to have a couple links down below if you want to join the Discord or the Factory Reset secret group. That link will be down below. I'll have a link down below to SwayFunded as well and a couple other things. So until the next one, have a good one.